The Greek debt crisis may have quite an impact on U.S. economic growth and the dollar. Sebastian Mallaby is director of the Center for Geoeconomic Studies and a senior fellow at the Council on Foreign Relations. He joins us now from Washington to offer his perspective on the crisis. Sebastian, welcome to Bloomberg News. Good to have you on.
Great to be with you.
Sebastian, you say that it's outrageous that the markets are getting blamed for the debt crisis we've been seeing in Greece. Why?
Because this problem was created by the Greek government, which spent way more money than it could afford and created a budget deficit of more than 12% of GDP. And then it lied about it and pretended the budget deficit was only 3.5% of GDP or something. So it was profligate and then dishonest. And to blame somebody else for that mistake is just to shift the burden and scapegoat somebody unfairly.
Well, Sebastian, if I might ask you then, the Greek Prime Minister, Mr. Papandreou, will be meeting with President Obama in the Oval Office. Do you think that Mr. Obama and the administration will take that tough stance with the Greek Prime Minister?
It's too politically unpopular right now to stand up and say that markets can be right sometimes, even if that's the truth. So I don't expect that the markets or the speculators or the hedge funds will get a ringing endorsement from President Obama. But I hope at least he shows some restraint in what he says. I mean, so far we've had the German leader, the French leader happily sign on to the Greek-led witch hunt against the markets. And you can understand why. The Germans and the French are just trying to divert attention from their own splits, their own internal difficulties, their own inability to deal with the Greek crisis properly. And so they're trying to blame the hedge funds and scapegoat them. I don't see why President Obama should sign on to that kind of behavior.
Now, Sebastian, I'd like to ask you about some of the details of Greece's plans to resolve its crisis. Today, the Wall Street Journal is reporting that Greece might put out another $13.5 billion of additional bond sales this month. Do you think there'll be demand for those? And do you think that Greece is all in taking the right steps to resolve its issues?
Well, I mean, the key question is political. They can announce various kinds of budget cuts and spending cuts. And the question is, do the public sector strikes force the Greek government to cave on that? I mean, there's a record in Europe, particularly in France perhaps, of the government announcing various kinds of austerity packages and then they simply don't stick. And the key thing from a market perspective, I think, is to understand that to win this battle against doubtful debt holders, the Greek government has not merely to kind of just keep its head above water. It has to get its whole body out of the water. As long as it's still a little bit above the water, it's going to probably drown. Because from a speculator's point of view, if the Greek government can only just keep things going, it means there's no downside to betting against them. What can you lose? You might win a whole lot if they do default and you're going short on the debt. But if you're long on the debt, if you're short on the debt and then they actually survive, it's just going to be flat. So from a speculator's point of view, there's an asymmetrical bet unless the Greek government does something really radical and brings the deficit down by, let's say, 6 percentage points.
Other than contagion to U.S. stock markets and other global markets around the world, what kind of impact specifically is this Greek debt crisis having on the U.S. that you're seeing right now today?
Sure. I mean, there's two channels of potential contagion to the U.S. The first is simply that U.S. exports will suffer a little bit. The Greek crisis means a weaker euro, a stronger dollar. A stronger dollar is bad for exports. That's bad for jobs in the U.S. export sector. So that's one effect. And clearly, for President Obama, who's very worried about jobs and is promising to, in the State of the Union address, to make growth in exports a central plank of his strategy for getting out of 9.7% unemployment, a weakening euro is a major problem. Well, but the other thing, actually, is the psychological factor in the marketplace. If the markets look at Greece, which in 2009 had a deficit in the budget of 12.5% of GDP, and they attack Greece and Greek defaults, then they're going to turn around and say, well, who else has got 12.5% deficit in their budget? And the answer is, in 2009, the United States had the same size of public sector deficit. Now, there's lots of differences between the US and Greece, but I still think that once the markets start thinking along those lines, it could be dangerous for the United States.
Sebastian, we have about a minute left. Yesterday, the German Chancellor Angela Merkel told members of the Foreign Press Association in Berlin, quote, "Our instruments are not sufficient." She was talking about helping Greece. She said the European Union must be able to respond to the challenges of the moment. If today's meeting in the Oval Office is basically a photo op, who are the real players here? Is it the European Union, the International Monetary Fund, the Greek government, all three?
Well, the main player is the Greek government, which has to try to get its own house in order. The European Union, as Angela Merkel said, does not have the instruments to intervene, and German law makes it very difficult for the Germans and the Europeans to provide a bailout. That means bringing in the International Monetary Fund ultimately, but there's a lot of political resistance within Europe to allowing the IMF into their own backyard.
And Sebastian, we're going to have to leave it there. Sebastian Mallaby, director of the Center for Geoeconomic Studies at the Council on Foreign Relations, joining us from Washington. Sebastian, thank you so much.
Great to be with you.